So hopping right into the charts here, we'll go over a little bit of theory before we start applying it to what the market's actually doing. So if we're in a bullish trend, for example, and let's suppose this is a 15-minute time frame that we're drawing out. If we're in a bullish trend, we expect price to do something similar to this, right? We're having a bullish move. We then have a pullback, putting in a low somewhere. That low then breaks out, making another bullish move. We then have a pullback, and we continue on until you typically see this movement start to tighten up, leading to failure, which then begins a bearish movement, right? And you'll notice that in a bearish movement, we have a bearish leg, we pull back, another bearish movement, breaking this low, a pullback, another bearish movement, breaking this low, a pullback, and we continue onwards. So there's a few things with this. If we know that we're in a bullish movement, we expect these highs here to be broken until we see something contradictory to that evidence. And we'll go over failure and whatnot in the next module. But for now, what we're looking at is in a bullish trend, we expect a high, a low, a high, a low, and so on and so forth. Now, the interesting thing is if you look at this retracement, what you'll find on your lower time frame is that it's doing something similar to this before you find a rejection, and then we start moving, delivering to that high, and you'll see some sort of price action similar to this. The reason is because our lower time frame is making its own structure that you see on the higher time frame, right? As it facilitates this retracement back down to the prior area of interest. Then after failing, it then continues on. And this is what we mean by the lower time frame facilitating what the higher time frame order flow is, right? So this bearish movement is completing its objective, and now the higher time frame can continue, right? Until the higher time frame will eventually find its movement. And then what you'll notice in that is that you have maybe your 4-hour chart doing something like this before then continuing higher, right? And then beyond the 4-hour chart, you'll have the daily or the weekly that's doing the exact same sort of thing, and the 4-hour chart's got its own structure that's forming, facilitating what the time frame above it wants to do. Now, this is actually what we mean by price being fractal, right? You've got something happening on every time frame, and what it's doing is if your daily or your weekly wants to go higher, the 4-hour is going to do something specific. Inside of the 4-hour, the 15 minutes going to do something specific. Inside the 15-minute, the 1 minute is going to do something specific. And even down to the seconds time frame is going to facilitate the exact same thing for the 1 minute. Okay? So all you guys need to know, at least right now, is that when you're identifying a trend, you're looking at these highs facilitating pullbacks, the pullbacks finishing, forming a new high. This now becomes a protected low. So just to go over it again, if you have a bullish trend and you're here, you're expecting this movement to break that high. After you get a confirmed break of this high, we expect a retracement back down to the midpoint of the prior zone. And if we find failure in here, we then expect to break that high continuing onwards. That is similar when we're looking at the lower time frame movement where we break this, we then trade back in. Our expectation is the midpoint of the prior zone. And to confirm the prior zone, we're looking at the down move in a bullish trend, right? This is the prior swing. We're not looking at this current move. That's the current swing. That's something different. We're looking at the prior move, because when we break out, we're now looking for that retracement to then go long. And we look for that retracement to occur in the prior swing. Okay? So let's look at some charts, and I'll show you guys what I mean. Okay? So if you have this movement, what you've got is you've got this bearish move where we have a high, a low. We trade back into where? The prior swing here. We then trade lower. We then trade back up to where? The midpoint of the prior swing. We then trade lower. We trade back up to where? The midpoint of this prior swing. Now this actually chopped around, and what you'll notice here is that this movement could not put in a new low. It stopped here, and then it traded above. What this means is that we actually expect it to break above this high. We consider this to be a weak high in structure. Highs need to be responsible for putting in a new low. If we refer back to our picture, we confirm this movement when this low breaks to a new high. Not before. Not when it's here. Not when it's here. It has to break this high. After it does that, now we can start looking for that lower time frame retracement back in to go long, because we know that this swing here that it's tapping back into is now responsible for a significant price movement. And now we're looking to go long, right? So if we look at this chart and you were looking in here at a short position, this high was responsible for significant price movement. We trade back up into it. Our expectation is to short, and we expect to make money. Same thing here. This high was responsible for price movement. Now this high was not. So trading back into it, if you took a short position in here, you would have lost money. Why? Because this high did nothing. We actually failed above this high, yielding another movement. And this is where market structure gets tricky, because we expect at some point this movement to lead to rejection. And when we expect that rejection, it has to do with how late in the trend we are. Otherwise, trends would just go on forever. So you'll notice there was a bit of a change here. We've now got 1, 2, 3, 4, 5. This is the 6th attempt to reverse the trend. This low could not make a new high, and we took both of these. And what ended up happening after we broke below here and failed is we started a new trend. Okay? So what we have to know is that this movement is getting late in its trend. We've now got failure. We expect to trade above all of this. And it did. And then we had higher time frame failure occurring here, which means that this low was not valid for significant price action on our higher time frame, and we came back down for that low here. This low then tried breaking up above here. It couldn't. So what happens? We come down for it. We then failed underneath here, right? Trading back in, and you'll see that we start a lower time frame movement here, eventually leading in breaking this high and going on a rocket ship, right? But what you guys need to know right now is that when we confirm that this low is strong, we're now looking for that retracement, and this gives us our high probability area of interest to look for an entry.